Hello, everyone, and welcome back. In this second round, we'll take a closer look at how some of the world's most influential and respected investors are putting their money to work. Now, it's important to remember right from the start, these filings only cover investments in publicly traded U.S. companies. That means they don't include all of the private deals, the European or Chinese stocks, or other kinds of assets that many of these managers hold. So while we get to see a big piece of the puzzle, it's not the whole picture. Still, even this partial view is incredibly valuable because it shows us how some of the sharpest investors are positioning their portfolios. Let's start with Warren Buffett and Berkshire Hathaway, because whenever Buffett makes a move, the market pays attention. The biggest headline this quarter is that Berkshire reduced its Apple stake by about 20 million shares. That's a cut of nearly 7%. Apple has been the cornerstone of Berkshire's portfolio for years, but its growth has clearly slowed down, and the stock isn't cheap anymore. Trimming here feels like a logical decision. They're not abandoning the position. Apple is still by far Berkshire's largest holding, but they're locking in some profits and diversifying a bit more. And that brings us to one of their most interesting buys, United Health Group. Berkshire bought just over 5 million shares, and I think this is a really solid move. The healthcare sector has been under pressure recently, but United Health is one of the strongest operators in the business. With costs stabilizing and long-term demand for healthcare only going up, the upside here looks very attractive. There were other changes in the Berkshire portfolio too. They reduced their stake in Bank of America slightly, trimming about 4%, and not a huge change, but still worth noting since Bank of America is one of Buffett's favorite financial institutions. More dramatic was the complete exit from T-Mobile. Berkshire sold all of its nearly 4 million shares, which probably reflects a view that the company doesn't have the kind of durable competitive advantage that Buffett looks for in his core holdings. On the buy side, Berkshire added aggressively to Lennar, the home builder, increasing that position by more than 260%. They also more than doubled their stake in Pool Corporation and made a modest addition to Chevron. Meanwhile, Charter Communications was cut almost in half. For me, the main story with Berkshire this quarter is really about the Apple trim and the United Health buy. The smaller moves look more like the kind of stock picking done by Buffett's deputies rather than Buffett himself. But overall, I think this is a thoughtful reshuffle, reducing exposure to a maturing giant like Apple and rotating into a beaten down but fundamentally strong name in healthcare. Now let's move over to Bill Ackman and Pershing Square because his trades this quarter were some of my favorites. The headline is his massive new position in Amazon. Ackman bought almost 6 million shares, which makes it one of the biggest positions in his portfolio. And honestly, I love this move. Amazon is still a growth machine, with AWS generating huge amounts of cash and e-commerce continuing to expand. The valuation relative to its long-term potential is very attractive right now. It also happens to be my highest conviction stock, so seeing Ackman take such a strong position here only reinforces my confidence. He didn't stop there. Ackman also added more shares of Alphabet, increasing his stake by about 20%. This is particularly interesting because sentiment around Google has been shaky. Investors are worried about AI competition and how it might impact search, but the reality is that Google's core business is still flourishing. Ad revenue remains strong, YouTube is growing, and the company has one of the deepest AI research pipelines in the world. Buying more here when others are nervous is exactly the kind of contrarian but logical move that can pay off. On the other side of the ledger, Ackman completely exited his position in Canadian Pacific Kansas City, one of the major North American railroads. Now, I've owned railroad stocks myself, both Canadian Pacific and Union Pacific. They are fantastic businesses, strong moats, reliable cash flows, and they'll be around for decades. But they don't grow quickly. They're the kind of companies you buy when you're already ahead in life, maybe in your 50s or 60s, when you just want dependable returns. For an investor like Ackman, who is looking for outsized growth, selling Canadian Pacific and reallocating that capital into faster-growing tech names like Amazon and Google makes perfect sense. He also made small adjustments in Brookfield and Hilton, but those were minor compared to the big tech moves. If I had to pick a set of trades that I liked the most this quarter, it would probably be Ackman's. Concentrating into high conviction growth plays while exiting slower, more conservative businesses is exactly how I'd want to be positioned too. Next, let's talk about Triple Frond Partners. This is a smaller fund, but their portfolio is incredibly focused and has been performing really well. They are very tech heavy, concentrating on the big names that have dominated over the last decade. Microsoft is their single largest holding, making up more than 20% of the portfolio. Then they've got Meta at 12%, Amazon at 11%, and Alphabet at 10%. Add in positions in ASML, Lam Research, and Transdigm, and you can see how much conviction they have in technology and high-quality industrials. This quarter, they boosted their Meta position by more than 40%, and that turned out to be a brilliant call. Meta has been one of the best performing stocks of the year, and adding aggressively ahead of that rally shows real conviction. They also added significantly to CCC Intelligent Solutions and trimmed their position in Transdigm. When you step back and look at the overall portfolio, it's honestly a dream lineup of big tech companies with proven track records. Microsoft, Meta, Amazon, Alphabet, ASML. These are the kinds of businesses that dominate their industries and continue to grow at scale. And Triple Frond isn't just sprinkling in small amounts, they're putting real weight behind these names. For me, this is one of the cleanest and most appealing portfolios out there right now. It's concentrated, it's high quality, and it's the kind of setup that can outperform for years to come. Now, let's move on to Dennis Hong and Shawspring Partners. Their trades this quarter were a bit more mixed in my view. The most notable buy was nearly 1 million shares of Okta. I'll be honest, I'm not entirely sure I understand this one. Okta is growing, yes, but I don't see a clear competitive moat that sets it apart in the crowded cybersecurity and identity management space. There's upside, but the risk feels high compared to other opportunities out there. On the selling side, they exited Hilton completely, which I think was a smart move, likely locking in gains. They also cut their stake in Monday.com by more than 25%, and considering how the stock has performed recently, that was probably good timing. Intuit was trimmed by about 17%, though they still maintain a position. I like that they're holding on to Intuit because it's a very strong company with durable advantages. Overall, Shawspring seems to have done some smart profit taking, but the Okta buy stands out as one decision I wouldn't necessarily agree with. Finally, let's wrap up with Daniel Loeb and Third Point. Unlike some of the other investors we've looked at, Loeb runs a more diversified portfolio and makes a lot of moves every quarter. This one was no different. The most eye-catching change was a massive increase in NVIDIA. He almost doubled his position, adding more than 90%. With all the excitement around artificial intelligence, NVIDIA remains at the center of that story, and Loeb is clearly leaning into it. At the same time, he completely exited positions in EQT, US Steel, Discover Financial, AT&T, and Hess. These are more cyclical or slower growth businesses, and it looks like he's cleaning house, making room for higher conviction plays. Some of the other notable buys included Capital One, where he increased his stake by more than 70%, and new positions in Mr. Cooper Group, Comfort Systems, and Danaher. He also more than doubled his stake in Primo Brands and added significantly to CoStar Group. And like Ackman, Loeb also boosted his Amazon stake and picked up a small new position in Meta. The way I see it, Loeb is spreading his bets across a wide range of opportunities, but he's still clearly bullish on tech and growth, with NVIDIA being the centerpiece. Personally, I prefer more concentrated portfolios like Ackman's or Triple Frond's, but Loeb's approach gives him flexibility and diversification while still capturing upside from some of the biggest trends in the market. So, stepping back and looking at the big picture this quarter, we see Buffett trimming Apple and rotating into healthcare, Ackman going all in on Amazon and Google, Triple Frond building an incredibly focused tech-heavy portfolio, Dennis Hong making some interesting but more debatable moves with Okta, and Daniel Loeb spreading out across a wide mix of growth names while doubling down on NVIDIA. For me, the most exciting trades were Ackman's huge Amazon buy and triple Fran's bold move into Meta. Those are the kinds of high conviction plays that really stand out. Of course, none of this is financial advice. It's just my analysis of what the best investors in the world are doing with their portfolios. And with that, we'll wrap it up. If you enjoyed this breakdown of the latest 13F filings, make sure to hit like and subscribe for more content like this. Thanks for watching, and I'll see you in the next one.